Welcome everyone to this Insights Institute talk with Aleksandar Andonov. So this conversation is a very pertinent one for where we are in time. We recently put out a paper, Investing in Uncertain Times, Achieving Disciplined Flexibility with the Total Portfolio Approach, and talking about how we use liquidity and governance. When markets are under pressure, we tend to see that investors, in particular potentially ones who claim that they're long horizon, may behave in ways that are inconsistent with their design and intent. And Alex here has done and built a body of research on this topic, which is really quite interesting. So he's a professor at the University of Amsterdam. His work focuses on how large institutional investors, in particular pension funds, actually behave under pressure. Not what they say they'll do, but what they actually do. And one of the most interesting things about Alex's work is the data sets that he's managed to collect about the actual activity of these big investors and how they behave under stress. He is informed policymakers, investors around the world. He's been quoted in very august publications such as the Wall Street Journal, Financial Times, and The Economist. So it is a great honor and privilege to have you here today with us, Alex. Welcome.
Thank you. It's a pleasure to be here. Thank you all.
I'd like to start things off with a real easy question.
It's actually quite a challenging question, but if I think more broadly about it, there are certain aspects on a higher retirement system level across these schemes that are quite interesting. I think Europe has a bit advantage in the sense that it offers broader coverage of the employed workforce, and in that sense it can provide more security in the retirement stage, etc. So on the long run, at least the countries in Europe that have pension funds kind of can put less pressure on the government finances in that aspect. One other aspect that is nice in the US and the European systems, going down a bit more to the investments, is that we do get more data and then there is more transparency. So these systems, we have studied them in a lot of detail in terms of how they respond to in periods of stress, so how they move assets from one asset class to another, etc. We have examined in more detail their investment behavior. The Canadian system is praised a lot for very strong governance, and I think they have championed internal management and building internal teams. I think the entire, let's say, world looks at them in this aspect, but in that said, I think other systems have been studied in more detail, in terms of their actions and outcomes. So that would be a bit, but in that sense, Canada has the advantage of promoting the strong governance of pension funds, where they put a difference between that representation does not necessarily mean that you need to come from workers, etc. That there is a bit more focus on the knowledge and skills of the board members. I think you can see very large differences. I mean, starting with my old research that used, for example, CM data, etc. Canadians immediately stand out with the amount of internal management, whether it's in listed asset classes, equities, fixed income, and all the way to real assets, infrastructure, even private equity. They will stand out there. I think you see them more in co-investments deals if you search around, much more. So there is a lot of attention there and a lot of space. The other aspect, which is very interesting in it, maybe we come back to it later in terms of liquidity, is the role of leverage. I think Canadians were the first to introduce. We have seen leverage among US endowments that they have used or thought about using credit lines, etc., lines of credit. It is different than what other pension funds are doing around the world, and it can be you need to know how to manage it, but it can be a beneficial factor sometimes in times of stress.
One of the really fascinating things about your work, when you've looked at, in particular, the U.S. Public pensions, is just that role of governance and how heavily that can influence portfolio outcomes. So I'd be curious if you could give us a sense of some of those dynamics in terms of, we think about boards, we think about accountabilities that are delegated to management, to give us a sense of some of those dynamics that you've seen within that world.
I think it's a very important point. The role of governance is closely related to the total portfolio approach, because to start with, I think the board needs to understand kind of the responsibilities they're delegating. And you need to have a board who is comfortable to delegate and who understands kind of what they are delegating. And then you need to have internal staff, internal teams who are able to implement this kind of flexibility in a good way. That means that I think now there is a lot of discussion on like moving more from SAA framework to TPA framework. But again, if you don't have the institutional capacity, it's really hard to say that you will be able to implement it successfully. And it's not something that you can, same thing for the internal investing. It's not like you can say it's working well. These institutions managed to reduce costs. Let us try to do that. That kind of, you cannot just copy paste there. I think it's similar with the TPA. It requires very strong governance. It requires first board who is comfortable with delegating flexibility, but still can monitor the most important aspects, and then internal teams who can implement it, and that's kind of critical there. It can give you it because you, as you said, like it needs to be implemented in a responsible way. So that's again a work that has been done more on US public pension funds, and on a high level, I think if you want to be successful as a board member, you need to have the right skills and the right incentives. If one of these things fails, kind of, you might be less successful. So that's kind of, you need to have both of this. And what we saw in the US context is that what is interesting in terms of academic studies, most of their boards are fixed by state statutes and even in the constitution, sometimes written in a state, which means they're defined really back in the past, before they started implementing like alternative assets, investing in private markets, etc. So they were defined kind of before our study. And then we can link it to what is your board composition, to what kind of investments you make in private markets. We can attribute to who were the board members in a year when you committed capital to a fund. So that will be to link them to this vintage year. So we really know kind of the board who decided on these investments. And we do see that more political boards, they tend to invest, for example, pension funds with more politicians on their board, they tend to underperform in private equity. And part of it is driven by, let's say 1/3 can be explained by investing more in local venture capital, local real estate funds, because they tend to get lower. This is the place where the returns are dramatically different. On the board, you can have a more kind of a person with experience in the finance industry, etc. So we do find kind of both that the incentives matter, where the politicians might have incentives to overinvest in the local economy, and then the skills matter. So if you have board members who are less skilled, kind of it's challenging, especially in more opaque asset classes such as private equity, venture capital.
In your work happening in these stress events, is what's written on the tin actually inside, or we see something else?
Yeah, I think pension funds are still long horizon investors with predictable liability structure. But often I think regulators, policymakers, and even researchers, they put equal signs that if you are a long horizon investor, you can be a liquidity provider and contrarian investor who can stabilize markets. The challenge here is that at least most US public pension funds, we got more detailed data on them. Now they're cash flow negative on an operating basis, which means that their inflows from contributions are lower than their outflows or benefit payments. And the average US public pension fund will be cash flow negative around 2.5%. The European pension fund, just glancing across the larger ones, will be also in a negative territory, let's say on average. And even the Canadian plans, many of them will be in this space. But we have examined in more detail what it means for the US plans. And if you are cash flow negative, kind of, that means that you become net seller in financial markets, in regular net seller. And then it's not so easy to say that you will be able to provide liquidity and let's say stabilize markets when they're going down. Part of the negative cash flows are structural. In a sense, these plans are maturing. So if you try to see what explains the negative cash flows, there is a predictable component in that the proportion of retired members relative to the total number of members is going up across them. And that explains this gradual shift from like being cash flow positive to being cash flow negative. Now, that explains the predictable part, and that is structural. On top of it, there are some shocks that pension funds experience. And this comes back a bit more to the, let's say, regulators or the sponsors, employers behind them, because we have seen cases where the employers do not pay the required contributions. That's a negative shock. Or there can be governance designs in the plan where, for example, policemen, firefighters, they allow for deferred retirement, but then they allow for lump sum withdrawals suddenly. That can also show up there. So this is maybe in a plan design that can be addressed by governance. Now, what is also important to be addressed with governance or portfolio management is, given that you have such cash flows, like how to adjust your asset allocations, how to plan your investments so that you are better prepared to kind of pay your obligations. What we study first is like how do they absorb these negative cash flows, let's say. And what we see there is that, as I said, like a large component of them is predictable. And these predictable negative cash flows are absorbed by something I would describe as pro rata selling. So they sell a bit assets in line with their target asset allocation. So they sell a bit of fixed income, 50% is $1 is met by 50 cents sales in like public equities. And even there are some kind of cash flows that come from the alternative assets. Think of it, ideally they want to have higher distributions than capital calls, which will be enough to balance the portfolio. Now, what is interesting is how do you absorb the negative shocks, which, as I said, can happen if the state or city says, like, our tax revenues are lower, we're going to pay you lower contributions this period. Or if you experience these sudden withdrawals. And there we see that a lot of it is absorbed by public equities. Because I think these pension funds sit on limited liquidity buffers. If we think about liquidity buffers as money market funds, treasuries, etc., most of the cash flow shocks are absorbed by selling listed equities. And that's kind of the evidence we see. In extreme cases in US, they were even absorbed by selling private funds and alternatives. So they're quickly passed through to these other asset classes. And that's where I think governance can play a role, that you start to think how to be better prepared for such shocks.
I was looking at some of the work you were doing. I think that's also where the total portfolio approach has a potential role to play if you're not in those narrow asset class bands where, I mean, it makes sense to sell a slice of a portfolio if you're in that situation, you're trying to maintain yourself within governance limits. But if you have a more flexible setup, then that is a potential mitigant.
Yeah, I think it can help. It also creates some additional challenges. In a way, it's helpful because also a lot of assets are internal, so you can decide. When you have external managers, selling means redemption requests to managers so that need to be met, etc. Even the dividends are not passed through to you. They're often like reinvested by the manager. So it really means, like, for most of the pension funds around the world, redemption requests to managers. Now, if you have a total portfolio approach with internally managed assets, you're more flexible to decide how to sell or whether to reinvest dividends or coupons, etc. So that gives you additional flexibility. It also, in terms of challenges, is that we talk about some US pension funds selling private equity fund stakes, but I think it's even more challenging if you need to sell private assets directly. And I think that's something that is unique to the Canadian pension funds, and it does require more flexibility and kind of care there, that these assets are even more illiquid, and it's not kind of easy to find buyers for them if you need to sell them.
For sure.
But then there is the role of leverage also that might be useful if used carefully in a way.
And you know, you mentioned earlier on the conversation how the Canadian funds were trailblazers in terms of the use of leverage, and you've also mentioned, I think, in one of our earlier conversations, just how the Canadian pensions are now kind of converging in terms of their cash flow profiles to the US. What do you see implications from that, or things that we should be paying attention to?
I'm not sure whether you should be paying, because CPP is very different from the rest of the Canadian.
It was a leading question.
Yeah, and I think then you can comment more on the role of CPP here. But this was just exploratory analysis. So collecting the same thing we did for US funds is, let's compare the contribution inflows versus the benefit outflows of the larger 25 Canadian plans. And what we see is that they transition from the entire industry, transition from, let's say, 10 years ago being slightly cash flow positive, 2014, to now being cash flow negative by about minus 1 point something percent. CPP, as I said, is the exception, that if you do value weighted average, it will pull it higher. But if you look at the rest, they were not necessarily there like 10 years ago, all of them. So that makes it a bit different. And they might be converging to where the US plans are now, but it will take some time if I look at the data, because as I said, there is a predictable component, so it will take them time to get there. It requires being, again, they have more flexibility. They have governance where I think there is a stronger understanding on the board and more internally made decisions rather than you rely to these relations with asset managers to manage it. But again, like leverage can be used here to help.
As we sort of, we've seen a few cases, like for example, in the UK with the LDI crisis a couple of years back, where you could be doing well if you're solving, trying to improve your funding ratio as a pension plan, that you could be doing well on one dimension, but creating risks on other dimensions. So what observations do you have in terms of how pensions are managing those other risks as they're seeking to improve a funding ratio?
Yeah, I think it's interesting that in both UK and Netherlands, they were to some extent hedging interest rate risks, but they were only partially doing that. And the outcome of that was like when interest rates started rising, basically their liabilities were falling down faster than their assets. And that means that their funding ratio was getting better. So they were, if you want to say in solvency terms, they were getting more solvent. Like the regulators, if that's the primary kind of number that the regulators look at, they looked better on paper. However, this move was pretty sudden for them, so it was depleting quickly their assets. And I think in UK we saw that particularly pension funds who were invested through pooled vehicles, etc., were vulnerable to this because they were not so flexible to replace kind of margin calls, respond to the margin calls. The Dutch pension funds seem to be a bit more flexible. It also, I guess, played a role, in my view, a bit, let's call it the supply side, that for Dutch pension funds it was euro bonds, and selling them to influence the price of a euro bonds is harder than the gilt price. So I think if you're a smaller economy, kind of it matters how safe is your safe asset in that dimension. And for UK, that might be the reason why they experience, in my view, more challenges than, let's say, the Dutch in the same context.
Have you seen, in terms of your work, how pension funds are trying to balance some of these things? So, as we think about it at CPP Investments, we are looking at the sustainability of the plan, but we're also simultaneously trying to build a diversified portfolio. We're also simultaneously trying to manage our liquidity profile at the top of the house. Do you see, in terms of your travels, other pensions that are similarly trying to maintain that balance, or are they? Is there an unfortunate over focus on funding ratio, for example?
The focus on funding ratio, I think, will go down a bit in Europe with the reform in Netherlands, and I think in UK a lot of these plans are frozen, etc. So it will become less of an issue over time, particularly on the corporate side. So it might go down. On the other hand, the cash flow problems, I think they will, or challenges, they're not necessarily problems, they will stay there, and it might put pension funds to search more assets that are generating cash flows. I think they might be less willing to finance assets which require a certain period to be created, even though there is an expectations from governments that they will do this. But I think the need for cash flows will put them more to look for operational assets rather than it becomes for many of them less attractive to look for assets kind of that need certain years to develop cash flows. And the other thing is I think many pension funds will be looking more carefully, and other investors outside this world, of your cash flow position, because it's not obvious that you want to invest in the same, let's say, asset manager or a project with a pension fund who is more cash flow negative, because they might have very different preferences in terms of what to do afterwards with the revenue that the project is generating. So there might be some differentiation across plans there.
I did want to give you an opportunity. So this is the portion of the talk where you can ask for anything you want. And this is, if you think about Canadian pension funds and you want to study them to the same depth that you would study the US funds, like what information would you need? Does it exist today? How would that facilitate the work you do?
One unique aspect is that we see some plans trying to follow it in US, like the leverage is pretty interesting. And beyond, let's say, information, which plans allow it and how much, we have very few insights into how it's used and how much they have used. And so that can be one unique aspect where we learn something that we don't know from existing studies, and also how it kind of relates with other aspects of the portfolio, like the usage of, for example, derivatives and other holdings at the same time. So that can be. But if I put any research question, I think that would be kind of, for me, the most interesting, because it's most unique to the setting. Other plans now say they want to follow a bit the Canadian approach here, but I don't think it has been rigorously examined, because we don't really know, at least on the outside, what Canadians did. So it will be good to learn that one kind of before recommending it around.
But you would not just like this current year's data, you'd like 20 years of data, I'm sure.
Usually
So
we
you
do, like
build a nice panel.
we want a nice panel, big sample, so not only CPP, but to cover, let's say, the industry. Because for example, the work we did on US is we send a public records request to 180 US pension funds. We got responses from half of them with their quarterly holdings, etc. And then we say a good response is at least 5 years, but we want to have it for longer, and then ideally quarterly. The Dutch central bank, the panels they build are also covering like the 40 largest, etc. So you want to have a good coverage in terms of assets under management, and minimize sample selection, let's say there. That funds that were not happy how it worked out, you want them also responding in a way.
Mm-hmm. Absolutely, absolutely.
I think what we find is, for example, to confirm your point, is that which plans are more likely to sell equities when they get negative cash flow. What we see is that especially kind of plans with high allocation to alternatives, or the opposite side of that coin, lower allocation to cash and fixed income, they are more likely to sell equities, which means that they have very limited liquidity buffers in place, and kind of that's why they rely more on selling listed equities. Now, why would they do that? Yeah, it's correct and fair to say that kind of they have incentives to reach for yield. They're also underfunded, so keeping a large liquidity buffer is costly, because the expected return on these assets is lower. Now, what can they do about it? I mean, the first thing they can consider is that, let's say, to minimize the exposure to liquidity shocks, there are certain states and sponsors who have implemented, let's say, paying the required amount of pension contribution has a priority in the state finances. They cannot get around it. So there are states when it's, I think Arizona was one example, Wisconsin, usually they generally always tend to, like South Dakota, they always pay the full amount of required contribution, and that minimizes the exposure to shocks. So that means that you only have the predictable component to manage, and you can think about it. On the other hand, like if you look at the examples of the Dutch and the UK pension funds, they had a lot of liquid assets. They had a lot of fixed income holdings and so on, not 100%, because they also need to get some expected returns. Otherwise, it's very costly kind of to offer these pension products. But even in that case, we saw that kind of some of these hedging and margin calls, they can be substantial, like 15-20% of assets within a year, and liquidating that on a rapid basis can create pressure. So even if you have these liquidity buffers, if your selling is correlated, it can still lead to pressure in financial markets.
Yeah, I mean, it's one of the benefits that we have in terms of we have to always be cognizant of potential shocks to the Canadian economy, which could flow through into those contributions, but they are typically very stable, and there's a strong governance around how those contributions are made. So I think that from our standpoint is something that helps us be a lot more robust.
Looking only at the predictable part simplifies things if you don't have these positive negative shocks.
Yeah.
Yeah, it's a good question. I think US pension funds rely more on consultants than other countries. It comes back to this idea of how strong is your internal team and how many decisions they make. And they tend to use two types of consultant. One is this general consultants, and on top of it, recently they added more and more specialized consultant, like within private equity, within real assets, within hedge funds, and so on, which help them particularly in selecting managers. The general ones are involved a lot in the asset allocation, And it seems to me that these general consultants, they come a bit with a set of, let's say, capital market assumptions and recommendations, which we observe that they're a bit more uniform across their clients or pension funds, which suggests to me that they're not tailoring their recommended asset allocation to, let's say, the liquidity position of a fund, to the maturity of the fund, to other factors which might be fund specific. It seems to be like a one-size-fits-all approach. And if the pension fund is listening a lot, you can bundle like pension funds with very different characteristics in terms of these plan characteristics, implementing the same allocation while it's not suitable. So I think they play a role, but again, I mean, they're only providing a recommendation there. So it's still ultimately the board that implements and the staff that implements this and can adjust the recommendation.
See, all the questions were going to be easy.
Yeah, whether it becomes forced seller or not, I think allowing, I would put there, based on the example, what we saw, the biggest shocks in US were cases which are small pension plans, but think about Dallas Police and Fire, allowing lump sum early withdrawals. I think for them, and if you're underfunded, it can create a run. So in that case, that was a run that kind of resulted in 20-something% of their assets being withdrawn in a period of like 4 months. And that resulted in selling approximately 20-something stakes in private funds in real estate and private equity, in liquidating almost entirely their liquid equities, etc. So it was like a unusual case, but I think it's an important decision that it doesn't like a bit like the open-end private credit funds, allowing liquidity with illiquid stuff, it doesn't work out very well.
And I think, just as we sum up here, a lot of your work, which has looked at these different dynamics, has looked at, the potential mismatches of governance and investment strategy, or the influence that governance has on investment strategy, how you manage liquidity, and how these things are all really interconnected. And you can't look at pension fund performance without also looking at the environment and the structures in which they operate, the structure of their plan, how their governance is set up. So, and then to show that all with empirical data to demonstrate the patterns, I think it's very, very useful, a great contribution to the overall body of work and understanding that we have in this area.
No, thanks. I like working in this area. I mean, what is quite interesting is that people are required, it's mandatory to join pension funds in many cases, but then we don't collect so much data. So the data is important. Like you choose in which mutual fund to invest, but then we collect like their monthly holdings. And for pension funds, kind of you're required to join, and they're kind of, we don't disclose so much, but still it's a lot of work to get the data, but I do believe it's important, these questions to study.
Excellent. Well, Alex, I just want to thank you for joining us today and contributing all of your insights.
Thank you very much.
Thank you.